Welcome traders to another skill development course for the call and ratio put backspreads using the Tradebench software. So we are going to continue right along with the same topic of how to put these things and track them into this cool software I've been using called Tradebench. This one is going to take a lot of creativity, folks, but hopefully if you follow along and watch this video, you can actually pause it and write stuff down, so on and so forth. We can figure this out. So let's jump into it, guys. The first thing we're going to do is we're going to find what we want to talk about, which is our directional options. We're going to scroll down here to Module 4, Directional Options. This is where we're going to pull our PDFs, fillable PDFs. You've watched the video. You guys are now very excited and ready to go out and trade some of these call and put ratio spreads. If you're like me, folks, I trade these primarily on the options, or excuse me, on earnings announcements. They're a lot more fun this way. So I have two different worksheets. I've got a call ratio spread worksheet and a put ratio back spread worksheet as well. I'm just going to pull one up for an example. Now, if you guys have figured this out as you have been going through the courses before we finish up what is going to be the directional options classes, you notice that each one of these has a opposite, a call ratio and a put ratio. You could also almost assume, now folks, double check just in case, but you could assume that the entry criteria in the trade management systems are going to be very similar to both. So I'm not going to waste too much time when it comes to regurgitating what you just spent hours learning. But here is a nice area of where you can check off the entry criteria. You can take a look at some management suggestions and systems. Now you can modify these a little bit. You can modify them shorter term, longer term, deeper out of the money, so on and so forth. So understand that this is just kind of a base place to start. As you'll see that I have a little bit different rules when it comes to me setting these up personally. It doesn't mean it's right, doesn't mean it's wrong. It's just something you might see as I build my watch list, or my checklist, I should say. Might be a little bit different, but you'll learn all these as you go through the course in different types of ways to do this. Remember, folks, the PDF is just kind of your basic standard type, and you can modify it from there. Okay, so we have the ideas we're looking for. It's definitely a +3 outlook. We like to put these on something super aggressive like FDA approvals or earnings announcements, things that are going to really move the markets. Trade management system's pretty cool because this is why it's difficult to put in the Tradebench, guys, because we are dealing with a credit spread that's very deep in the money. We're taking that credit and we're buying excess calls or extra calls for a move greater. So you actually have a whole bunch of long calls and a deep in the money credit spread. I've come up with a way, I believe, that we can use Tradebench to track this as just one trade, although it is going to be a two-part system. Now, if you take a look down here at the trade management system, so it says after the, adjust the position with after 2 days of the event. So if it gaps up, it gaps down, what you want to do is you want to, in this case, sell the excess calls immediately because we want to avoid the volatility crush. Now, guys, you just heard this class. Why am I saying it again? Well, I'm stressing to you that this is a two-part exit strategy, and this is the only way that this is going to work. Let's say that you decided to get out of the excess calls and the credit spread all at once. That's fine. You still have to enter it into Tradebench as a two-part strategy, and I'll show you how to do that. You can see that if you wanted to carry it over multiple days, this is what's great. You get out of the excess calls, and then you sell you just go ahead and keep that bear call spread. You can also do the opposite. If it gaps up really high, past where the volatility crush does not hurt your options, and you still think that they have a chance to continue further, you can go ahead and close the credit spread and let those options go. I'm going to show you the exit, or I'm going to show you the entry on the whole trade. I'm going to show you the exit in both parts. Which one you do first doesn't make a difference as long as you know where to look. All right, guys, bear with me. This is going to be a tricky one. And it's, here's the good thing is, it's the trickiest one out of the bunch. Past that, it's pretty much straightforward. So the first thing I would do, like we always like to do with our Tradebench, let's go ahead and get into our configuration and make sure that we have a strategy for it. Now you guys can see that I actually went ahead and put the strategy in, as I have with most of these. Let's see if we can find it here. This is the call ratio spread, and then you can go a little bit lower here and you can see the put ratio spread. Let's go over and just hit the edit button and see if I've got a checklist for it. I do. I'm going to show you that checklist, by the way, guys. I actually copied and pasted. You can use a Snagit. That's a cool tool, or there's a cutting tool for free. If you guys have Windows, you can just cut and paste into here. It's kind of neat just to have that here. You can put any notes you want to add as well. It doesn't matter. I keep them pretty raw, personally. So now that we have that, let's go to our checklists. Now, a couple things with the checklist as I start to build this. I'm going to show you my checklist, guys, but understand it is a modification of the general checklist that's on the PDF, which is awesome. You guys are going to modify this as well, depending on how you like to use them, when you like to use them, so on and so forth. There's no wrong way to do it. Just make sure that you have something to bounce ideas off of. So you can see down here in a little bit, I've got the ratio backspread. Now, notice it doesn't say call and put. The reason being, folks, is because the call and put, to me, are the inverse of each other. They have the same rules, they have the same structure, and the same outlook, just in two different directions. That's all. So there's nothing more I need to do. Now I'll show you my checklist. I'm going to go ahead and hit the edit button. Hopefully that'll let me get to it. And this will show you what I've done. I like to buy and sell my strike prices within the expected range. And this is based on a volatility play, right, folks? We talked about the volatility increasing. We talked about volatility crush and the expectation of the underlying move based on how many people are buying calls and puts. So I like to stay within that range when I buy and sell my strike prices. I buy as many out of the money strike prices as possible, in this case calls, and still keeping a credit. Now, folks, I like to keep myself a juicy credit. And what I mean by that, if let's say that I've got a position to where I could buy one extra call, but it takes my credit from 68 cents down to 18 cents, I'm going to go ahead and just not ratio that and keep myself a nice 68-cent fat little credit. And it just, for me, it's just knowing that I've got the back end just in case. You can really squeeze these, and I've seen traders actually go to zero with the credit and just maximize that direction. However, if it does go the opposite way, once again, it might hurt them. Now, folks, this is off topic. It's just a personal preference. So keep some sort of a credit. I guess that's the story there. And then the selection expiration date is within the week of the announcement. I know that we say do 2 to 3 weeks past the announcement. This will give you a massive advantage when it comes to I want to get rid of the credit and keep my long calls. If you're a trader who wants to get rid of that credit spread, let's say this gaps up, and you want to keep those long calls, you do not have the convenience of doing the expiration week. If you're a person that needs to sell those calls immediately and then maybe hold that credit to see if it comes back down or sell the whole thing all at once like me, then you can trade within the expiration week of announcement. If you feel like you're going to hold those calls, and maybe this wasn't stressed in the class course or the course, folks, but I'm going to do it now, then you cannot trade the day of announcement. You do have to do 2 to 3 weeks out. So follow the rules that are on the PDF. So mine are just a little bit different. No big deal. Everybody's a little bit, kind of the same there, or same but different. All right. So those are my checklists. That's my rules. Now I'm going to go over to my trading plan. Now, as I was building this course, and folks, I'm going to have to tell you, I have done this video 2 or 3 times, and the reason being is because I went to use an existing full trading plan, and I went to new trading plan here. In fact, you can see I have one up here for a trade that we're going to talk about. I had a problem when it came to this area right here, the planned entry price, planned target price, planned stop price. Now, I have to enter these amounts along with over here the risk, quantity, commission, so on and so forth, before I can even save this as a hypothetical. So what's tough about this, folks, is if we don't trade as a new plan, then we can't use the checklist, right? So when I go ahead, actually, let me go ahead and type in the one we're going to talk about here, which is Adobe. But you'll see that when I click on ratio spreads, if I can find it, call ratio spread, it gives me the checklist. So I can do the checklist, I can see, make sure that it works, so on and so forth, but it asks for values. And if you guys know as well as I do what you just learned with the ratio spreads, they're very difficult to do when it comes to my planned entry price is going to be a credit, but my target price is way high or way low. There is no stop, because if it goes down, you're going to keep your credit. So it's super, super difficult to use a trading plan. So what I've done is I've just superseded it and said, look, keep your checklist written to your side, make sure that you're following your own rules, and let's just go ahead and do it without a trading plan. Now keep in mind, guys, the Tradebench is to journal trades. The Tradebench isn't to help predict or figure or evaluate or compare. It's just a journaling software. I'm about to compare here. Well, I've already preset this trade, but this is where you compare, is on your software. Now, I've been using Thinkorswim for these, and I'm going to continue to use Thinkorswim for these, but you can get all this information on different types of trading platforms, especially if you guys are already at the Interactive Brokers Trader Workstation. If you don't know what I'm talking about, you'll find it here coming up shortly in some of these videos. So let's take a look at our chart. Now, folks, I put this on yesterday. The announcement is today after the close, so I have already experienced a little bit of volatility. This also gives me an opportunity to teach a little bit when it comes to adding these into the Tradebench, which once again, it's a complex combo, so it's a little bit complex when it comes to entering it into the Tradebench. So let's take a look at what I've chose. I'm just going to go to Analyze. I'm going to go to my risk profile. Now, folks, down here you can see exactly what I've taken a look at. I am looking at, and it's also checked this because I've actually purchased this exact scenario. I have the 265, 285 ratio spread for a credit of 90 cents. And that's what I closed it at. Now, here's my risks. Here's my reward. We can add price slices when it comes to it. Just to give a quick, a little bit of an overview, folks, I don't want to reteach this course, but I chose the strike price, 80 delta, sold 5. See down here, I sold 5. I was able to afford 5 and keep 90 cents. Now, this did move because it's live right now, but when I go to the monitor, you'll see that I got 90 cents for it. So following the same rules, staying within the expected move up and down. Let's show you what that was. It's over here. It's expected move of plus minus 12 bucks. That's what I chose. So let's go to the monitor, because this is where you're going to get your information. Once again, Tradebench is not an analytical software. It is a journaling system. All right. So this is the one. This is Oracle here. Don't worry about that. We'll talk about that in our next trade. So you can see this is Adobe. Now, Adobe is the trade that I made yesterday, and it gives me my trade price. I got a 90-cent credit here if you guys do the math. If you go $2.51 times 5 minus $13.45, you're going to come up with a credit of 0.90. This is where we're going to focus. You guys need to focus on two things: the call, what you sold, and the calls, what you bought. You need the trade price. Here's the two things. The trade price is your cost basis, and the mark price, which is after the event or after something happens or whatever it is you're looking for, because this is how we're going to use the calculations to put these into Tradebench. So let's start with my Adobe trade. My 265, 285 call ratio backspread. Let's jump over to Tradebench again and start entering the position. Now, folks, when it comes to the symbols, and you've probably already figured this out watching the previous videos, you get as detailed as possible. So I know that these are the Adobe 21 June. Now, this will date the class, folks, but that's okay. 21 June. I'll write the whole thing out. 2019. 265/285. And now I'm going to put in my ratio. 1/5 call ratio backspread. I like to say backspread in one word. Some people do two. I don't know the difference. So this tells me exactly what I've done. I bought I sold 1 265, and I bought 5 285s. That's a 20 spread. It's a call ratio backspread. I did it in 2019. The expiration cycle of June. So it's a shorter term. I used Thinkorswim. Now it's going to ask me for a multiplier, guys, and I've done this, like I say, a few times. Put it at 100, because over here on the order quantity, we're going to use contracts. It just does the math a little cleaner. Now, let's get into our strategies. Well, we already know which one this is. We already built the strategy, so it's a call ratio backspread. I'll just check this. Now, here's some fun stuff, guys, and I don't think that I showed you this label because I built it in one of my classes that failed. So I put it over here as an earnings announcement. That's a fun one. So put an earnings announcement. This is definitely a +3 scenario. Let's go back to the chart, because I like to do these kind of as we go. Kind of a symmetrical triangle consolidation move. So, you know, all these are just little keywords when it comes to your labels that when you go to scan, it's going to be nice to have. So I'm going to put consolidation here. What was the other one? Symmetrical triangle. Where's that? Break up. See, symmetrical triangle, break up and down, because I think it's going to go up. And this is where I put in my numbers. Now, folks, these numbers become Really, really awesome to have just in case you lose track of where you are in the trade. So, earnings play. Expected move of plus minus 12 bucks, right? And then you can do a little bit of math there. Let's go back to where the chart is currently, because I know that it's moved since I did this yesterday. So the stock is currently at 278, so I can just go $2.78 plus 12 bucks equals 290 for the up target. Now, I'm trying to get as detailed as I can for this class. Understand that you can get a lot of information based on your broker account. All you have to do is just go, hey, what I do on this last week or last time, so on and so forth. You could pull up all this information. You could put it in after the fact. However, I've found this is much easier to do before this goes haywire, before it pops up and goes crazy. In fact, it's cool because you guys can see that within a day this is already gapped up since I put this thing on yesterday. So this is going to be kind of neat because we'll have some comparisons that I can show you when it comes to exiting this trade. So I'm going to take that same $278 and I'm going to minus 12 bucks from it, and that gives me a lower target of 266. Just put it in there for fun. Here's something that really, really helps. Separating out the costs for each leg. This is big. So I'm going to go back to monitor, and that is here, my trade price. So I sold the 265 calls, and I brought in $13.45 for credit. Now, I might add something a little bit different here, because I'm going to add an extra note because I want to know what 1 to 1 is. So if I take $13.45 minus $2.51, which was my average cost for the calls, I get $10.94, which means if I go back to Tradebench, the 265/285 bear call spread credit was $10.94. This is going to make things easier when we exit this. Okay? The 285 calls were $2.51, and you could put per contract just in case you want to know what that is, because we're going to use that number when it comes to the cost basis, because we're going to put them all in at once. So these are pretty important things. And then you could say total credit of 90 cents. Now, how did I get 90 cents? You guys didn't see it. You can do the math. You take that 13.45 and you minus, or you take 5 times 251 minus 13.45 and you'll get 90 cents. That's the total credit. So that's, get as much information as you can down here. It looks like this is pretty good. Now let's go back and put in the order. Now usually with a 1/5 ratio spread, I've got a 1-to-1 call ratio backspread, or excuse me, 1-to-1 bear call spread and 4 extra calls. Now I have to include both of them on the same ticket. So I'm going to put in all 5, yes folks, all 5 contracts in here. Now this is where it gets a little bit tricky, because if we do the total, it's a 90-cent credit. Let me scroll down. If we do the total, it's a 90-cent credit, which is going to mess the math up. If we do the bear call spread, it's going to be a $10.94 credit. However, we paid, using some of that money, we bought 4 extra calls. So the best way to do this is to put in the average call price, and then we'll work our way backwards once we close the position. So just put in the fill price of $2.51 and click away, and it gives you, total commissions, national value, so on and so forth. Now, this is not in any way reflective of what our risk is. It is not. Our risk is going to be at the bottom of that elbow when we get, when you take a look at the risk graph. Technically, our risk is the spread minus the credit, which in this case is $20 minus 90 cents, which is going to be $19.10. So it's almost $2,000 of risk, not 12. Now, but don't worry about that. That will also be calculated in your Thinkorswim or your Trader Workstation, whatever you're working with. Now the target price and the stop loss price I superseded because this just messes up the math in Tradebench. But what's awesome, if you scroll down here, folks, guess what we did? We put it right down here in the comments. This is also so much easier when you go to review your trades. So everything's looking pretty good. Let's go ahead and submit, and it'll tell me if I've missed any boxes, but I don't think I have. Okay, now I have my Adobe trade. Now you can see I've done an Adobe trade in the past, but this is the one that we just did now, and I can tell why, because it's my 265, 285, 1/5 call ratio backspread. It's a big mouthful, right? Okay, so let's take a look at what happens. We're all good. It's all fine and dandy. Now the announcement's happening, or I can take into consideration what's going on right now. You have a mark price, and you have a trade price. Now on Trader Workstation, folks, and other types of trading platforms, they might be shown differently. I think Trader Workstation has current and cost basis. That's the same thing you're looking for. Thinkorswim calls it a mark price, which is basically what's the going rate for this call and put right now. It's beautiful that they do them individually. We're going to have to do a little bit of math, but in the long run, it's nice. It's really, really nice to have. Okay, so right now you can see from yesterday that the $13.45 credit I brought in for selling the 265 has increased. That's actually hurt me. I actually owe $15 to close the position. Now on the good side, the $2.51 calls that I bought are now going for $2.78, and I've got 5 of them. So let's figure out a scenario of how we can tell what happens when it happens. So I'm going to see if I can't supersede these prices. Let's see what I can do here. And I'm going to make them fair here. I'm going to go to Analyze, and I'm going to take into consideration these deltas, and I'm going to say that this stock moved up $10. Now, this is hypothetical because there's going to be a massive volatility crush. Okay? Massive volatility crush in these markets. And what I'm doing here is I'm just going to use straight delta, even though the delta will change per dollar with a move higher or lower. Based on how in and out of the money are. So I just want to do something hypothetical. Or what we might do, no, there's not enough of a variance there. Let's say that it moved up $10. So based on this, I've got a $10 move at an 81-cent delta. So I'm going to go $10 times 0.81. And that means that the 265 would increase by $8.10. If I have a $10 move to the upside with a 32 delta, $10 times 0.32, that means it increases $3.20 for those calls. So what's really cool about that is I go back to my monitor, and we're going to change this mark price to hypothetical. One thing that I've actually done here for you guys, and this is where you might want to pause the video as I move forward, is I built a little calculation sheet, which you can do. I just did it. You can see it's right here on a Word document to where you can follow this. I've actually filled these values in, so let me get rid of them. So you have a fresh one. So this is basically what you want to keep as a template, okay? Because what we're doing is, again, guys, we have to get creative. Oops, I guess I could get rid of the equal sign too, to make this work. Okay, so the first thing I'm going to do is I'm going to say these values, and maybe I can block this down a little bit, have increased by $10 based on their delta. So this 13.45, I need to add $8 to it, so I'm going to go 13.45 plus 8. Now don't get confused here, guys. I'm just building the hypothetical. Okay, so the 265 call is now worth $21.55. The 285 calls is now worth, let's do the math here, $2.51 plus 3.20. Okay, so don't worry about what I just did because I'm creating a hypothetical, 5.71. Now let's also, since we're here, combo. Now this is if we're just doing the one-to-one, right? Is now worth, let's see what the combo would be worth there. Let's just do minus 21.55, 1584. All right, guys, so I've got these three values. Now, we don't have to do what I just did here. It's going to be up in the mark once the move happens. Okay, I'm just doing this so we can have something to look at. So I'm just going to go ahead and hide this because I'm going to say it hasn't changed. So I can just reference our trade price. So the first thing we want to do is take the mark price for the credit. Okay, so what is the credit's current mark price? Well, it's right here, $15.84. Let me do that again. And I'm going to minus that from our trade price. And our trade price was, oh, I have to do the math again, it was $13.45 minus 250, $10. Let's start with that one. $10.94. Let's put the mark price in here as $15.84. And what we do is, this is going to give us the difference of just the spread. Now guys, I just did 1 to 1. I'm calculating the credit spread. It's going to be really obvious how much money we made on the calls because I just take, $5.71 and minus it from 251. But if you do this first, we'll be able to put it all in at once. So gain loss on the credit spread. I'm going to take what the current price is, $15.84. That's how much it costs for us to close this. So that's how much we have to pay. Then I'm going to minus the $10.94 that we brought in. And that's a difference of $4.90. So we're down $4.90 in the spread, right? So I'm going to put in minus 4.90. However, we have a 90-cent credit. This is that loss gain plus or minus the credit. So in this case, we have the credit, and we can take that from what we owe. We can add it to the $4.90, which means, pretty easy math there, it's a $4 loss. Okay, let's do this. Hit the minus button. So we are sitting currently on a $4 loss in the vertical spread, in the vertical credit spread. Now I'm gonna just skip this guy here for a second, and let's figure out what we made on the calls. So we're exiting this, right? We got to exit it. I've realized, hey, it moved up 10 bucks. Let's take a look. I'm going to hit add the exit order. Now, one of the first things we do, and you can see according to our plan, is we get out of our excess calls, which is how many? 4. And the fill price was very, very simple, guys, because let me go back to it so you can see it. And let me pull up my little worksheet. The fill price on these is easy because we bought these originally for $2.51, and according to my hypothetical situation, they're now worth $5.71. Pretty killer, right? So all I have to do is just put in $5.71, and it should take care of that math for me. So let me jump back over here and put in $5.71. Great. Don't need a target price. Don't need any of that. Sold extra calls after favorable move. Still holding the bear call spread if you want to. Now I'm not going to, because I'm going to immediately just turn around and sell that as well just to make it one trade. But you could hold that. Say they gap up and you think they're going to come back down. Well, it might be better to hold that call, because right now we're sitting on a $4 loss on the, hold that credit spread. Right now we're sitting on a $4 loss, but if that goes down and down and down and down, and the volatility keeps sinking, we could actually regain some of that. Now it'll probably end up still being a loss, but we could recoup some of it by waiting. It just depends if you believe in a counter move. Once again, that's strategy, philosophy, so on and so forth. Not part of this class. So I'm going to go ahead and save this. And what it's done is you can see that it's already kind of calculated it. Hey, look, we got out of 4 out of a total of 5. Excuse me, we're still sitting on 1 with that average cost basis. This is where we have to be aware of the average cost basis. It still think it's at $2.51. Okay, so what I need to do is go back out. So let's say we're going to go ahead and close the combo. And let me go to our worksheet. And let me go to our trade. Now the next thing we need to do, we need to subtract or add the total to the original cost basis used in Tradebench for the long strikes. Right? So we have to take $2.54 $2.51 and minus our loss just the line above of $4. And that equals, let me just make sure my math's right, 2.51 minus $4 is a loss of $1.49, or a basis of $1.49. Now, why this does this, guys, is because it sees that we have $2.51 of value in the starting point. We need to minus that. We need to minus what we lost from the starting point. So what we're going to put in here is not a plus or a minus. It's going to be $1.49, which takes into consideration we lost we lost 251 and the difference of it. So that is going to be the loss. Okay, let's go back and put that into our Tradebench. So hit add exit order, because as you're going to see, folks, this is going to be a gain. It should be a gain overall. Fuel price $1.49. What we did is we just took into consideration the difference of where the cost basis was minus the loss of the credit spread to it. So I should say total on remaining credit. Go ahead and hit submit. Let's see how we did here. This does take a little bit of time. And what I'm going to do is I'm going to move over to the put ratio and just do something a little quicker using the same everything, but a little faster. Okay, so you can see, awesome. It gives us all of our entry, what we did, how we did it. It gives us our first exit. Did really well at the 270, and then the other one not so good. Total gain loss, net profit is $1,157 with everything included. Here's our beautiful breakdown. It worked out perfect. So let's jump straight over to a put. And as you can see, I've already built one on Oracle. So let's go over to my charts, see if I can't do a really quick breakdown. Same idea. I went through, I analyzed it. I looked at the potential move to the up and the downside. I figured out what strike prices I wanted. You can see over here. Played very similar of a game that I did to the call side. I decided to do a 55, sell 155, buy 3 51s. Kept myself a 70-cent credit. We can double check that as we take a look at it. Let's go look at the risk graph real quick. Run your numbers. Make sure this is acceptable. Kind of neat. Expected move to the upside, so on and so forth. I'm not going to take the time to type everything out on this because, we're pressed for time. I want to make sure you guys understand it. Now what this did, now I did fill this morning, so it does still have my full credit. Yep, still 73 cents up there. You guys can write that down. In fact, let's just go back to Tradebench, and I'll start putting this thing in. This was a June as well, 51.55, 73-cent credit. I'll start there. So let's jump back to Tradebench. Let's go to trade plans. And remember, guys, I did it without a trade plan because you can use an existing one with the checklist, but you'll have to come up with hypotheticals, right? Let me show you real quick how to get around that, just in case you want to do that. If I wanted to put in, the Oracle trade, I'm not going to type it all out, but because I will in a second here, type it all out, choose whatever I wanted, and I want to use the checklist. My planned entry, you'd have to kind of use it as a holding place, like set it for $1, planned target of $2. Planned stop loss of 50 cents. You're just trying to appease the software. You're going to put this in here as possible position sizing, because what you want to do is, I'll show you, because there's one in holding. What you want to do is get it to this holding area. In fact, I've got one in the holding area right here, and that's what I did. Let's go ahead and here I'll show it. I'll show it to you guys. I'm glad I kept this from yesterday. So you see, I was able to do my checklist. I typed in everything I wanted when it came to the back ratio spread, so on and so forth. My multiplier, this is still a long put ratio spread. Now I made this up. See, I said 1, 2, and 1 cent. This is all going to change once I get there because I know it's a 1/3. But then I also put everything else in here. -1 or 3. It's a bear rally, earnings announcement, whatever else you wanted to put on there. Earnings announcement, expect range of ±260, upper target, lower target. Let me continue with this. Boy, I'm glad I cut out a whole bunch of time for us. Total credit on trade was 73 cents. right? And now that I have the position, let me go back and let's break down each strike price. The 51 puts that I purchased, I got for 55 cents a piece, and 238 for the put I sold. Sold 55 puts plus $2.38 credit. Buy 51 puts minus 0.55 debit, and I could put in here per contract. Not necessary. Hopefully you guys will remember that, but there's all my information. So what's great, from here I can go ahead and hit submit and go to order entry. Okay, so remember, you have to be a little bit creative if you want to put it into a trading plan. So if you want to save trading plan, save a new plan, you got to put in 1 to make $2 and all that, because here when I go to add order, I could change it. I could change it to anything I want, because this is what I'm going to do, and I'm just going to copy what I did buy this bad boy at. And that was 55 cents. Remember, the debit is going to be of the excess calls or puts. So it's going to be 55 cents. Okay, order quantity, it's a 3-to-1, right? So I'm going to put in all 3 contracts. Hopefully my multiplier is still at by 100. It should be. Fill price was 55 cents. Okay, now my target price and my stop price, I can actually just get rid of those. Order triggered. Let's hit submit. Let's get that going. All right. Now once I get this going, let's go find it. Right there, Oracle. Let's say it happens again. Let's see if it gaps down this time. Should we make it work for us? I say we do. This will be fun. So let's pull up my little trusty calculator that I made. And I'm going to change the values here. I'm going to say that this gapped up $2, or let's say it gapped down $3. So I'm going to need to get, get the values here, and I'll change it over on the other screen. Analyze. Once again, you don't have to do this. I'm just doing this for the sake of the class. All right, so if this goes down by $3, the call is going to be worth 3 times 0.24, 72 cents. 0.72 on the 51, right? And this bad boy, woo, went 70 cents against us, right? $3 times 0.7. It's okay, $2.10 for the 55. Okay, so let's go back to our monitor, and I'll start typing this in. There's the Oracle there, so that would make the 51 puts is now worth, started at, let's see if I can do this real quick. Where are those? Okay, 51 puts are worth 55 cents plus another 72. Oops. 0.55 plus 0.72 equals, and they're now worth $1.27. The 55 put is now worth, and I didn't do it plural there, but I think you got to figure it out. Okay, that was at $2.38. Boy, now I got to add 2 more 10 to it. Plus 2.10 or 210 is $4.48. So what's the new combo worth? Let's figure it out. We only do one of each because it's just trying to find out what that combo is. 4.48 minus 1.27, $3.20. 3.20. Now, what you can do is I can put a minus here because we have to buy it back for $3.20. Now, guys, that's a lot because we only brought in a 73-cent credit. That's okay because we probably made it up on the long put side. So, actually, let's do it a little bit differently. Let's put in the long puts first, and then we'll come back out here and finish up the spread. So, because I like to start with a nice win. So I'm going to go to add exit order. Now this is a 2-to-1, which means you can see I love this because it says quantity is 3 left. So I just need to do 2. And the fill price on those 2 was let me bring up my little cheat sheet, $1.27. It's a lot. Okay. Calculates it. Everything's good. Sold extra puts on announce date, for example. All right. Hit submit. Wait for that to render. And let's go back and try to figure out the calculation for the credit side of things. So we'll jump over to our Thinkorswim, and we'll run that the faux move right against current. So I'm just going to hide the current mark because we're going to use this one, and let's follow our rules. So the mark price is, let's see, mark price for the combo, $2.38 minus 1 of the 55 cents, $1.83. This calculation we have yet to do, but you can see it's pretty easy to do there. So that's our, oh, excuse me, that's the trade price. See, I'm already getting confused. That's why you write down a cheat template. Very good. Now the mark price was hypothetically $3.20. Okay, so that's what we owe, and that's what we have. You guys don't have to be as detailed, but I'm just trying to, for ease of following it along. So what's the difference? Well, if we owe $3.20 and we pay back the $1.83, we're in the hole by $1.37. Okay. Now, that $1.37 is not going to be totally accurate because we brought in what? A 73-cent credit. So let's go ahead and take away 73 cents from that. $1.37 minus 0.73 equals 64-cent loss total. That's not too bad. That's not too bad. Okay. Now, see, so you're starting to see, folks, you notice how I'm building this credit the exact same day that I'm actually exiting the calls and puts? You're going to be hurt a lot less if you do this all at once. Or, I mean, excuse me, get rid of it at the same time, the same day, although we do have to go through the system to make sure that it journals correctly. So we take the subtract or add the total of the original cost from the original of the puts, and in this case they were 55 cents. So it's going to be a small loss, but not much. So we go 0.55, which is the original cost for the puts, minus that 67 cents or 64 cents, keep calling it that. That's going to give us 55 minus 64, 90-cent loss. Oh, that's wrong. Let's go 0.55 minus 0.64, 9-cent loss. Boy, that's nothing. That's basically break even. So, or 9 cents is what we're going to put in for the total, 0.09. All right, so that's what we put in for the total. All right, let's go back to it. And we need to get rid of the remaining position on our Oracle put ratio backspread. So I'm going to go add exit order because there's one left. And this one represented, remember, once again, guys, one long put and one short put. That's why we got those different values. It's not by 3. And the fill price was 0.09. And that's going to take into consideration our loss, total credit amount, or whatever else you want to put in, minus whatever. Let's hit submit. Let's take a look at our how it worked. All right. Well, one thing that's really cool about this too is these totals are automatically going to be added to the overall, and I'll show you that at the front page, which is kind of neat. So here's our total trade plan summary, our total breakdown. These are all the notes we took. See, I built it as a new trading plan, and then thankfully it was there, so I was able just to submit this as an order. And you can see what we did. It order triggered, and this is the price. This is where we got out of those calls, or the puts, excuse me, and then this is where we got out of the credit and everything. Actual trade summary, this is what happened. Total gain is 77 bucks. Not bad. Small, but not bad. You know, here's some labels: earnings announcements, bear rally, -3, so on and so forth. So it's all there. Now, if you go back to your dashboard, right there, so it adds to your grade at any time. Once again, I know this is off topic, but we can go look at our closed trades. We can see how we're doing, right? Here's that Adobe we did. Here's Oracle we did, right? These are the 2 trades we did today. Here's how we did. Made a bunch more on Adobe than we did Oracle, didn't we? So, pretty cool. All right, guys, thanks for joining me, and we'll see you next time. Actually, we're moving into the non-directionals. So, thanks again. Bye, everyone.